Welcome. We're going to get straight into something really crucial today, a discussion that my tax accountant actually helped arrange for us.
That's right. It's all about the UK state pension and, well, the tax side of things.
Exactly. Understanding tax on pensions, it can feel a bit overwhelming sometimes, can it?
It really can. Feels like wading through mud for a lot of people. So focusing just on the state pension part seems useful.
Absolutely. So, our mission today really is just to pull out the most important bits you need to know about how your state pension is taxed here in the UK.
Yeah, hopefully help you avoid any surprises and just understand what's expected.
We're drawing on guidance from places like Royal London and, of course, the official info from gov.uk and HMRC.
Solid sources. Okay, where should we start?
Right. The big one first. Is the UK state pension actually taxable income?
Simple answer? Yes, it is. Absolutely.
Both types, the new state pension and the basic one.
Yeah, both. The new state pension, which for 2025-26, the full amount is £11,502.40 a year. And the basic state pension, that's around $8,814 annually. Both count as taxable income.
Just like wages, then, or money from a private pension pot.
Exactly the same in the eyes of the taxman. It's income.
Okay, but here's something I think catches people out. The tax isn't taken off before you get it, is it?
No, that's a really key point. Unlike your salary, where tax is usually deducted through PAYE, they don't deduct tax as source from the state pension itself.
So how does that work then? How does it fit with, the tax-free amount everyone gets, the personal allowance?
Right. So it counts towards your personal allowance. For the 2025-26 tax year, that allowance is £12,570.
That's the amount of income you can have before you start paying tax.
Precisely. So you need to see how much of that £12,570 your state pension uses up.
So let's take the full new state pension. That 11,502 number, that uses up most, but not all, of the allowance.
Correct. It leaves you with just under, £1,100 of your personal allowance remaining.
So if the state pension is genuinely your only income, and it's below that 12,570 pounds allowance.
Then generally, you wouldn't expect to pay any income tax. Same for the basic state pension, which uses up even less of the allowance.
But things change when you add other income into the mix, don't they? Like a private pension.
Exactly. That's where it gets, well, potentially taxable.
Yeah.
If you're getting your state pension and drawing money from a workplace or private pension.
Then your total income could easily go over the 12,570 pound threshold.
Yes. Even a fairly small private pension on top of the full new state pension could push you into paying tax.
Okay, so it's taxable, it uses up your personal allowance, but if tax isn't taken from the state pension, how does HMRC actually collect it?
Good question. They don't send you a separate bill for the state pension tax usually. Instead, if you also receive a private or workplace pension,
Which many people do.
right, then HMRC typically tells your private pension provider to adjust your tax code. So the private pension provider deducts the tax owed on both your private pension and your state pension.
Okay, so the private pension sort of handles the tax for all your pension income.
In most cases, yes. If you happen to have more than one private pension, HMRC will usually just nominate one of them to handle the deductions.
Makes sense. But what if the state pension is the only thing you get, but maybe it's a very old, higher amount, or perhaps combined with other small bits that just push you over the allowance?
Yep.
No private pension to deduct from.
Right. Good scenario. In that case, if your state pension alone or combined with other non-PO income pushes you over the allowance, HMRC will likely send you something called a simple assessment.
A simple assessment, what's that?
It's basically tax calculation and a bill. It shows how much tax HMRC thinks you owe based on the information they have, including your state pension, and tells you how to pay it.
Okay. And what about people still working, maybe part-time, and getting their state pension?
If you're employed, then it's usually handled through your wages. Your employer will get a tax code from HMRC that accounts for your state pension income.
So the tax due on the state pension gets taken off your salary.
Effectively, yes. Your tax code is adjusted so that the right amount of tax for all your income, job plus state pension, is collected via PAYE from your earnings.
And finally, what about self-employed people getting the state pension?
Well, if you're self-employed, you're already doing a self-assessment tax return, right?
Usually, yes.
So you just need to make sure you declare your state pension income, along with all your other earnings and pensions, on that return. The tax is then calculated and paid as part of your overall self-assessment bill.
Okay, that covers the collection methods. You mentioned tax codes adjusting. Can we talk a bit more about those, like the standard 1257L code?
Sure. So 1257L basically tells an employer or pension provider that you have the standard personal allowance of £12,507 tax-free.
But when you start getting the state pension,
HMRC knows you're getting this untaxed income, so they'll reduce the tax-free amount available against your other income sources, like your private pension or your job.
how do they do that?
They issue a new tax code to your employer or pension provider. It won't be 1257L anymore. It will be a lower number, reflecting that some of your tax-free allowance is already used up by the state pension.
So if your tax code changes suddenly when you retire or start drawing pensions, that could be why.
Absolutely. It's HMRC factoring in that state pension income. Always a good idea to check your code seems right for your circumstances.
And what about this emergency tax thing? Can starting your state pension trigger that?
It can be a factor, yes. When you first start taking any pension, sometimes HMRC doesn't have the full picture of your expected income for the whole year.
So they play it safe.
They might put you on a temporary or emergency tax code. This often assumes you only have the standard personal allowance against that one source of income, which can lead to too much tax being taken initially.
Especially if your state pension should also be factored in.
Exactly. The good news is, if you do end up on an emergency code and overpay tax as a result,
You can get it back.
yes, you can usually reclaim it from HMRC, either during the tax year or after it ends.
Okay, good to know. Now, there's this term floating about fiscal drag. How does that relate to state pension tax?
Fiscal drag. It's quite significant here. Basically, you've got two things happening. The personal allowance, that £12,570, is frozen. It's not planned to increase until 2028.
Okay, allowance stays the same.
But the state pension usually does increase each year, mainly because of the triple lock policy.
Right, that guarantees it rises by inflation, earnings, or 2.5%, whichever is highest.
Exactly. So for 2025-26, for instance, it went up by 4.1%.
So the pension amount goes up, but the tax-free allowance doesn't. What's the effect?
The effect is to drag. More of the state pension amount gets dragged over the static tax-free threshold each year.
Meaning more pensioners might end up paying income tax?
Precisely. People who might have been just under the personal allowance before could find that the state pension increase, combined with the frozen allowance, pushes them into owing tax. It gradually brings more people into the tax net, or increases the tax for those already paying.
That's a really clear explanation. Are there any sort of quick strategies people should just be aware of regarding this? Not detailed advice, obviously.
Well, just general awareness points. Contributing to a private pension, if you're able to, is still a tax-efficient way to save, and those contributions can reduce your overall taxable income.
Okay. Anything else?
For some couples, the marriage allowance might be relevant. That allows someone with income below the personal allowance to transfer a portion of their unused allowance to their spouse or civil partner if the partner is a basic rate taxpayer. It can sometimes help reduce the couple's overall tax bill.
Worth looking into if it applies. So let's try and summarize the key takeaway then.
I'd say it's this. Your UK state pension is taxable income. It uses up part of your personal allowance.
And whether you pay tax depends on your total income from all sources compared to that £12,570 allowance.
Exactly. And the tax isn't usually taken directly from the state pension, but collected through adjustments to your other income, like a private pension or earnings.
Or via that simple assessment bill, or self-assessment if you're self-employed.
That's it. Understanding how it all fits together
Yeah.
is really the crucial thing to avoid those unexpected demands from HMRC.
Definitely. Now, if you're listening and thinking, my situation feels a bit unique, or maybe you've got multiple pensions, other investments, or just want tailored guidance,
Which many people will.
then the team who helped arrange this discussion, my tax accountant, are really the people to talk to. They have deep expertise in this area.
They can offer that personalized advice and support that we, can't give in a general chat like this.
Yeah.
They can really help navigate the specifics.
Absolutely. So do reach out to my tax accountant if you need that specific help.
Definitely worthwhile.
Great. Well, thanks for listening today. We really hope this has helped clarify how your UK state pension interacts with the tax system.